Beautiful. So we get another opportunity at starting all over again. Awesome. Thanks so much, everyone, for hopping on today. My name is Ayla. I'm the COO of Diffuse. I'm clearly more warmed up now than I was in round one of these introductions. Very excited to be here today. What Diffuse does, we run a suite of different crypto hedge funds. One is an index fund and then two DeFi funds. And we run an entire team that their only job is to find new opportunities for hedge funds that we can spin up or trading ideas that we can incorporate on our current vehicles. And that's probably why they asked me to hop on this panel and get our five gentlemen today to share everything that they know about interesting DeFi projects and products that are out in the market that we could potentially engage with. Now, as a quick overview, this space has not been around forever. I would probably say that a year or maybe 1.5 is how much of a lifetime this has had so far. But in that time, the number of projects that pop up has just massively accelerated. And it'll be really interesting to have Michael, Lex, Brian, Matt, and Mariano share a bit more about what they've seen come up in the past, what kinds of risks they are observing in the market today with these new products and projects. And then as last bit, what do they see for 2022? Where should we all be placing our bets? So sorry, guys, you'll have to get to do this one more time. Lex, do you want to kick off with a quick intro?
Absolutely. Wonderful to be here and fantastic to be with the audience. Really excited for this conversation. You can tell by my exciting rainbow background that I'm representing Consensys and Web3. And so Consensys is a company at the heart of the Web3 ecosystem. You might be familiar with our crypto wallet MetaMask. So if somebody's using a DeFi app, you're likely using it through MetaMask. And then, of course, people who write DeFi applications often use our developer tooling to connect into Ethereum nodes and Polygon nodes and so on. My role at the company is to co-lead the FinTech product group, which builds DeFi products as well as digital asset rails, as well as to be the head economist, which is a role that takes seriously the idea that we are going to be in a token intermediated set of digital economies, and that should be done with rigor, and and essentially that it matters how we build incentives into our digital ecosystems.
Beautiful. Mariano, would you like to share a bit about yourself as well?
Of course. Thank you. And GM, everybody. My name is Mariano Conti. I've been a part of the DeFi ecosystem for 5 years now, even before DeFi was a thing. I was a part of the Maker Foundation. We built the decentralized stablecoin DAI, which has been growing a lot in the DeFi space and a lot in the Latin American community. Today, I'm representing Vesto, which is an on-ramp into the DeFi ecosystem, mostly now for banks or large institutions that want to take advantage of things that DeFi gives you, like higher yields, investment opportunities, which is very interesting, especially now with the inflation. Of course, always in my country, Argentina, 50%, but now we're seeing the US 6%. So I think this is an extremely market that has so much space to grow. So I'm really excited to be here.
Thanks so much. Matt, would you like to share a bit about yourself as well?
Sure. Hi, everybody. Thanks for having me. So Matt Roszak, co-founder and chairman of Bloq. So at Bloq, we build crypto infrastructure, so nodes, staking, data, and also innovation. So last year or earlier this year, we launched Vesper, which is a DeFi platform. We were really inspired by what happened kind of the summer of 2020, where we saw the DeFi food festival of a lot of innovation, a Cambrian explosion of a lot of the DeFi Lego bricks that are starting to scale and really come into their own. But we also looked at some of the ways in which people engage and unknown teams and unaudited contracts, and a lot of those dynamics we felt like was unnecessary to have. So we kind of built Vesper with multiple audits, full documentation, known team, and also thinking about risk in a different way, where our pools have aggressive characterizations, conservative characterizations, so users are more informed on what's underneath that particular pool when they deposit their crypto, and I think that dimension as DeFi continues to evolve will be important. In many ways, today's DeFi participant via MetaMask is just sort ranking for yield, and that's certainly okay. I think as the market evolves and the kind of the macro need for yield and the shelter from inflation continues to get it into its own, DeFi is going to be a big beneficiary of that. And so I'm really inspired by the bridges, roads, and tunnels that we're all building in the space and where it's going.
Fantastic. And Michael, you are up next.
Thanks. So my name is Michael Shaulov. I'm the CEO and co-founder of Fireblocks. My background in mostly in cybersecurity for the last 2 decades. Started the company about 3.5 years ago. We provide market infrastructure for institutions, financial institutions, and businesses that are operating with digital assets and cryptocurrencies. Primarily the custody technology, wallet technology, all the governance layers, and so on. And we have about 600 clients, institutional clients that are using our platform at the moment, and sort of like the leading provider over there. And our journey with DeFi basically started almost 1.5 years ago with the first set of integrations that we built for the early funds that were getting involved in DeFi. And over the last 12 months or so, we basically continuously build additional capabilities that allow institutions to participate with DeFi across, and basically de-risking it through institutional controls, governance, secure wallets, and a lot of things that we're going to talk about today. Right now, we have somewhere around 20-25% of our clients that are using DeFi, mostly funds, but we see this as expanding to other categories as fintechs and others.
Phenomenal. And Brian, you're the last but not least on the introductions.
Thanks, Ella. Hi, everyone. Great to be here. My name is Brian Mahoney. I'm one of the co-founders of Alkemi Network and Chief Strategy Officer, where I oversee everything from business development, corporate development, and investor relations. What we're focused on at Alkemi, and that's Alkemi, just to clarify, because there's a few Alkemis out there, is what we're focused on is unlocking institutional capital to flow on chain. In short, we have at the core of everything a product called Alkemi Earn, which is a borrowing and lending product focused on compliance and solving what we call the trusted counterparty problem. We have over 90 plus institutional users on the platform to date, where users can deploy their capital for yields in a compliant fashion. All of our users are KYC'd. So in short, sort of DeFi ethos with a CeFi experience around it.
Awesome. And it kind of sets it off straight into the topic of the day, which is we'll kick off digging into these products kind of by the opportunities first. That said, even though DeFi has been around for about a year and a few bits, it's really difficult to kind of wrap your head around how it's actually structured. What does the landscape look like? Mariano, could you share a little bit more about how you would kind of mentally segment up the DeFi landscape as it is today?
Yeah, of course. And in fact, I was looking yesterday at some past tweets. And for example, 2 years ago, we had an actor create 150,000 DAI. So they minted it by borrowing against an asset. And also yesterday, but we had 150 million DAI minted in a single operation. So the sheer magnitude and growth, from 2 years ago to today is it's staggering. And I think we can segment DeFi into, I don't know. There is one big one that I've seen that is just DeFi 1.0 versus DeFi 2.0. That's been catching up. I don't know if I would particularly use it, but if I did, I would say there's the original projects, from last 2 years. They paved the way stable coins, money markets, borrowing and lending, fixed yield, with maybe a focus on, safety. And what I'm seeing now is that since most of these projects succeeded and they work and they've worked well and they worked through bear markets and now bull markets, there's this new trend to take additional risks. So things like rehypothecation, they're becoming front and center, and it is a little bit scary. But then I think about it, and the things we were doing a couple of years ago were also scary, right? So in a sense, I'm really excited about it. There are projects that are focusing on, safer strategies for yield generation. There are projects that are a lot riskier in a way. And I don't know, I'm excited to see everything grow. We're, like I said, a couple of years ago, we had maybe 1 million, then 10 million of total value locked. Right now, that number exceeds maybe 120 billion dollars. So we're maturing slowly.
Exponential growth on that side, and obviously pulls in a lot more new projects. Brian, I know you had a couple of thoughts on this topic as well. Do you want to share?
Yeah, in short, I would segment the DeFi landscape as food tokens and non-food tokens to go to some of the earlier comments about the food festival. No, just kidding. But in all seriousness, the space is dynamic. We have seen tremendous growth over the past 12 months. Categorization is quite challenging. But for me, I sort of think about the space, and sort of that old adage of history rhymes, but it doesn't repeat. Lots of parallels with capital markets infrastructure. The way I view, DeFi is just sort of an extension or the new frontier for structured finance. It unlocks, really infinite programmatic and creativity for financial engineers of the next generation, which is the internet capital sort of economy. And if you think about the segmentation of TradFi or traditional capital markets, right, it really boils down to 3 sort of layers at the infrastructure level: execution, settlement, and clearing. Right now, what you're seeing in DeFi is a bit of a bundled experience, right? There's lots of chains, lots of apps, lots of bundled, experiences on these different decentralized applications on, Ethereum blockchain or pick your chain. I think over time, we're going to see the bundling of that as the space continues to grow and capital comes in. But right now, it really sort of boils down into 2 buckets, which is sort of the borrowing and lending applications, at least on the financial side, and then as well as decentralized exchanges. And there's lots of competition, very fierce, but really a tremendous opportunity to innovate. And I'm quite excited for, the next wave here of innovation, or what we call DeFi 2.0 in the space.
That kind of follows on right into the next question, which is around returns. There wouldn't be so many projects if the anticipated returns weren't so tasty. Lex, what are your thoughts on some of the returns that can potentially be achieved by these projects that are coming up? Are they focused on generating hard cash for people that are engaging with them, or are a few of them more kind of community-based? What are you seeing in terms of the highest returning types of DeFi projects, and what can people actually expect to get out of investing in them?
So the silliest way I can answer that is to say, DeFi is great for diversification. If you want a safer portfolio, diversify into crypto assets. And so that's, of course, a silly thing to say relative to equities and fixed income and other traditional assets, but it's also deeply true. From a Sharpe ratio perspective, literally every portfolio, that's not being accurate, but in adding risk assets, whether it's crypto assets at a protocol level, or whether you're looking at particular DeFi permutations of investing within a certain financial instrument, you are getting exposure of a kind you just don't get anywhere else. And so even from the most prudent fiduciary duty financial investor perspective, I think people owe to do some diligence on the space to actually understand it, rather than have kind of like emotional reactions and philosophical trappings that they tend to have. But then to hop into like what is the asset class actually composed of? At this stage, it's irresponsible to paint with the same brush all the things, in the same way that there's a difference between what a Goldman Sachs capital markets desk does and what a large insurance company does and what a commercial bank does in lending to, I don't know, truck drivers to buy fleets. There's just a very broad plethora of protocols that perform different financial functions, whether they are generating yield or interest rates in the same way that a margin desk generates interest rates from people wanting to lever to go long or short. Similarly, protocols like Aave, Compound, and others generate interest rates based on the demand and the supply and demand for leverage. And then there are derivative structures on top of that that might allow you to collateralize certain assets and then get more leverage out of that. And again, there's a price that equilibrates based on how much people want to take a position in one direction or another. And so there is just that raw interest rate, right, which is people's outlook on the space. There's other sources of return that are equity-like in that you have exposure to a particular protocol, and if the protocol does well, you might be receiving its cash flows in some sense, or you might be getting an implied claim on the cash flows. And people use price to sales and on a bunch of protocols to understand how expensive or inexpensive things are. So if you're a private equity investor and you love leverage buyouts, this should be right up your alley. It's just a laundromat, except on the blockchain. And then finally, you can look at things like the issuance of tokens in order to catalyze certain activity to generate incentives for people to use protocols. And you can think about this in exactly the same way as PayPal paying you $200 to open up a PayPal account in the 90s. How fraudulent and scamful for PayPal to pay people to open up accounts. It's almost like Wells Fargo and Bank of America and HSBC paying you to switch your account to their depository institution. Similarly, there's lots of DeFi protocols that will spend marketing costs to get you to use their functionality and try it out and compensate you for the risk you're taking, cyber risk, protocol risk, programming risk, and so on. And so that's another source, right? The compensation for kind of being an early adopter. And so I just wanted to open those up because there's a lot of substance in all of them, and folks should hop in and kind of do the diligence on it.
Thank you. That was very thorough. I think there's a lot of digging there. You might get some enthusiastic emails after this. Michael, this is a question for you. Given there's such a plethora of new projects that are coming up, ways to engage with this ecosystem, in the last couple of years that you've been working on looking at DeFi and how to integrate that with your work, how do you make decisions on which projects to actually take on and which ones to pass on, just given how much work there is and how many new ideas and projects that are coming up?
Yeah, so I think that this is was a challenging area for us at the very beginning. That when we started, we basically only supported Compound, right? That was February or January 2020, and I think that basically what happened over the last year and a half, right, is that there was you see new protocols on a daily basis. So we really had to build an infrastructure that allows the protocols themselves, or basically allows this sort of generic connectivity to the protocols themselves through integrations such as through MetaMask and Wallet Connect and JSON RPC API and basically allow our clients at the moment to sort of access any protocol as they want or they see fit, given the fact that they've conducted their due diligence. Now, the reality is that actually what we're seeing in practice is that some of those protocols are so new that they are breaking up in terms of just their basic integrations, right? With off-the-shelf components, or they're not really functioning well, or they took all kind of assumptions around how transactions should look like, or how the interaction from the user side should look like, which are just too naive to work. And then there is a lot of work that we're actually doing with, some of those protocols of basically reporting back bugs and asking them to fix those bugs. So that's sort of like, on the long tail, and that's just sort of creating a generic support to satisfy the demand in the market. I would say that the most interesting part for us right now, beyond doing that, is that what we're starting to see is that eventually on the de-risking side, and to the comment that Lex made earlier, there are certain winners, right? There are basically protocols that became big that they already sort of bringing the attention of much bigger players, and for those protocols, we actually working hand in hand in creating like really structured support or vehicles that make them much more accessible, make the access to those protocols accessible to less sort of techy people that you usually need for the other protocols. So good examples of that is things that we're doing with Aave, things that we're doing with Compound, and some of those protocols that I think that they're sort of beyond the point of being in the long tail.
Yeah, that makes a lot of sense. And that digs up another question. Your team probably sources for new projects, or they get tossed at you at any point in rate. Matt, could you maybe share a little bit about your thinking around where to find new projects, either prior or post launch, and where do you source them? Is that a Telegram group? Is that your research team? How do you deal with this onslaught of new ideas?
Well, I think the landscape is continuously evolves, and the way I did a TED Talk that was the tokenization of things. I think DeFi is the financialization of things, and I think we're going to see a lot more innovation in DeFi coming from areas where how do I financialize this NFT or this sword or this helmet, and these new digital assets that are these tokenized assets are going to need chutes and ladders to get financialized, and whether it's lending markets, yield markets, etc. Then we're going to see a new wave of tokens representing real world assets that will go through the same chutes and ladders of being financialized. So I think there's a lot more room in DeFi and how DeFi is going to get defined. And I think there's a lot of builders out there thinking about these things on how to really exercise all the financialization of an NFT, of a gaming asset, of a decentralized land asset, and so forth. And then pretty soon, some of the real world assets will have a token, and then we'll go through the same type of dynamic. I'm really inspired by a couple things on how DeFi plays very differently from a lot of the other kind of traditional finance mechanisms, where your assets are always on a treadmill. They're always working in the chutes and ladders of DeFi, which is pretty inspired. And then two, the ways in which payments are made, there's things like streaming, which I'm very inspired by, and pay splitting, and all the ways in which you could do where you could distribute the funds or the cash flows, etc. So I think while DeFi has been really it's gone from its 0 to 1 moment from last year to this year, we've got a long way to go, a lot more building to do. And I'm inspired by the deals that are out there and the entrepreneurs that are building, and we're starting to see these the kind of next gen of DeFi, whereby back in the internet days, it was like, Facebook, Google, whatever. And then those folks that were there 3-4 years would spin out and build their own new net web ideas. We're seeing the same thing in DeFi, where the, some of the Maker, Compound, et cetera, entrepreneurs are kind of going for their second ride. So we're seeing that, the Googles of our spaces are those types of names in many ways. So that's really cool to see, and the volume of that is picking up. So the area is super vibrant on the native kind of DeFi space, and I'm also inspired by what Fireblocks and some of the other mechanisms are doing to connect institutions in this space, and that's a huge white space. Right now, the fact that majority of the assets and the TVL in DeFi comes through a blood vessel called MetaMask, which outside of this this panel and the participants, my neighbor or hairdresser or whatever doesn't even know how to spell MetaMask. So it kind of tells you where we are in the kind of evolution of DeFi. But institutions need these circuit breakers. They need risk management and better ways to engage. We're on the very front end of that, and so then I think about, where's this going to go from this permissionless and some of this permissioned, or maybe more of a risk-adjusted approach to participating in DeFi. There are other platforms that are building DeFi as we see it today. So taking the typical pools or gadgetry in DeFi, photocopying it and putting a KYC AML header on that to be more conducive for institutions to put a toe in the water. And I think that's a step in the right direction from a training wheel standpoint. Medium long term, I question how that's going to evolve between permissionless and the permissioned, and how those two worlds work and interact together. But there's a tremendous amount of white space and opportunity in both camps.
You touched on a very important point there, which is institutions trying to come into the game, and how important risk management is for that kind of audience, which is going to stabilize and really put a foundation underneath this ecosystem. What are the major risks in DeFi? And I think you can't talk about the topic without digging into the technical bits. Mariano, what are your thoughts on kind of the more technical risks that are underlying a lot of DeFi projects that investors should really look out for?
I usually do not sugarcoat this. There are many risks, and also that's why we have seen so many rewards, because a lot of people took risks early on. I was very much involved in oracles. I would say that is the ultimate risk in the doomsday scenario. Oracles. So blockchains are closed ecosystems. They know nothing about the outside world. So we call oracles anything that brings in any data from the outside world into this blockchain ecosystem. The most common one in DeFi is prices. We need to know the price of Bitcoin, the price of Ether in dollars, the price of any asset. And there are companies and there are projects who do their own oracles. And that is, to me, the thing that that sometimes keeps me awake at night. There are now stopgaps and safeguards, but really that is one of the main risks, the oracle risk. Of course, smart contract risk. All of the systems that we talk about, somebody, person or a team, they have to architect, they have to write, they have to test and deploy. And software inevitably has bugs, and blockchains are immutable by nature. So there is no picking up the phone and saying, "Hey, I sent my tokens to the wrong address. Can you please fix it?" There are extremely rare chances where recoveries can happen, but anything you do, you have to be extra careful. This also is a good thing because it allows people who actually want to join the ecosystem and learn about it to double, triple check, hopefully, key management. If you lose your private keys, then you cannot access your funds anymore. That's why it is important to learn about self-custody, but it's also important to learn about custodied solutions, maybe, because a lot of people in crypto like to say, not your keys, not your crypto. But yes, this is aspirational for the future, right? I'm not gonna tell my friend who I just said, hey, get into the ecosystem to learn how to self-custody their assets. So yeah, the risks, there are plenty, but as the space matures, we now have insurance. That we have protocols that provide insurance to people, to institutions, to other protocols even. It's still a little bit early, but it is growing. And, I feel a lot safer using DeFi now than I did before, even though, there's a good and a bad thing about things being permissionless and interconnected. Anybody can come in and build something on top of something else. That is great, and it's what one of the reasons why this space has grown so much. But also, it's like a double-edged sword, right? Anybody can build anything on top of anything else, and that leads to sometimes proliferation of scams. So like I said, due diligence, extremely important. Those are only a few. I like to talk about risks very, very often. But I think that, some of the smartest minds in the world are working 24/7 to mitigate a lot of these risks.
Yeah. And Michael, this one's for you, really leading on to this around custody of emerging assets. That's a massive risk. It's also a massive barrier for institutions to get involved in the space. Love to hear your views on, how do you custody assets that, don't end up on Coinbase? Is self-custody really a solution, an option at scale? What are your thoughts on that?
Yeah, I mean, so first of all, there is an interesting observation that needs to be made, is that at the end of the day, right now, if you want to use sort of like, fully fledged sort of like, bank-like custodian, right, such as, let's say, Coinbase, right, you simply cannot access DeFi, right? And the main reason for that is regulation, right? In order for them to hold or preserve their license, right, they need to basically screen any outgoing transactions that you're doing. And essentially, if right now, because there is no way for them to guarantee that you're not transacting on the other side of the DeFi pool with someone on the OFAC list, unlikely that they will actually allow you to do so, right? So that basically brings you to the point of, okay, so how do we actually do it, and how do you do it in an institutional way without basically getting into I would say running around with a Ledger Nano, right? And there's nothing wrong with Ledger Nano, but it's just basically something that from an institutional standpoint, you cannot manage, right? You need multi-user approval, you need guardrails like, transaction approval, you need to protect against various attacks that I'll explain shortly. And that's, I think, like, where solutions like Fireblocks are coming to play. And I think this is where we shine, right? So usually people sort of like, segregate the world to like, custodial solution and non-custodial solution. What we are, or self-custody solution. Basically, what we brought to in the institutional market, and there are also comparable solutions in the retail market, such as Zengo, is essentially the ability to create a distributed key management, right? Where you, as a client, whether you're an institution or a user, you hold basically a fraction of the key, and then the provider, such as Fireblocks, hold the other part of the key. It works beautifully well because we're using this technology called multi-party computation that essentially creates this distribution of the key and allows both sides to sign the transaction simultaneously. And as long as both sides agree to sign the transaction is signed and can be broadcasted. It also has really great properties, by the way, for DeFi, specifically the fact that it's very fast, right? So it's basically designed for on-chain interactions. So when you go to traditional custodians, one of the issues that you have is just the latency, right? If you would, use Coinbase or some of the comparable solutions, it can sometimes take them 24 hours to issue your transaction, which can be completely irrelevant for a lot of the DeFi protocols or a lot of the strategies. Whereas with MPC and what we provide at Fireblocks, you can sign and broadcast a transaction in a matter of seconds, right? So it really allows you the on-chain. It also allows you to sort of reasonably seamlessly traverse between different blockchains, right? So we have support for pretty much the leading EVM layer 2. Next week we are actually completing the release for all the layer 2 and EVM blockchains. You can basically provision any ERC20 token, but simultaneously you have the guardrails. Simultaneously you can basically say, hey, look, if I want to make a transaction into Compound that is above, let's say, $1,000. I need 2 people to approve it. And if I want to do the same thing into Uniswap, that I need 5 people to approve it. And if it's above that limit with this specific asset, and then you can basically wrap everything and you can whitelist the protocols that, or the smart contracts that people need to interact with, right? So it's a long story to basically say that the solutions to do it in a secure way where already exist today. They exist today both for institutions in the form of what we provide, and they exist today also to a certain degree for retail. Whether they're using a solution like Ledger Nano or they're using something like Zengo, which splits the key. But those things need to be really considered, and it's really important to make sure that the private key, as Mariano mentioned earlier, is being kept safe, and that you issuing the right transactions. There is also slew of risks that are basically operating close to the custody problem. So for example, how do you making sure that you're interacting with the right smart contract? I've run into this issue where I had multiple people pinging me in the last couple of months that just retail people that they basically went into a website, which was a phishing website. They connected their wallet into their website. They had a non-custodial wallet, and it was a phishing website. And then the first thing that you do when you interact with the protocols, usually they're requesting from you this approve all, which basically grants the protocol the ability to pull any amount of money from your wallet, right? So once they connected it, all their stable coins, all their ERC20 tokens, all their ETH was withdrawn from their wallet. And we're starting to see more and more of those sophisticated attacks, right? So the controls against what is probably would perceived as fraud or phishing is, again, something that I think we are working on solutions in that regard. We already have part of the solution. And I think that the controls around those attacks need to be more proliferated, both of the institutional side, but also into the retail side, to make sure that we just guard the users from just being completely robbed through those fraud and phishing attempts.
Yeah, well, it is a scary prospect. I think that's also why the government is trying to put a little bit of a bow around some of the activities here to keep, especially the retail investors, safe. Maybe we'll switch over, because we've got a few minutes left, into our crystal ball moment of the discussion. What is coming up next in 2022, given the regulatory system is trying to put a bit of a guideline around how to interact with DeFi? What are some of the more interesting, more exciting new projects that are coming up? And most importantly, will the newer projects that are coming to market be able to kind of displace the older ones that are out there? Matt, do you have a couple of thoughts on that, perhaps?
Well, we just kind of rounded the first year of DeFi from its kind of coming out perspective. And so there's been a lot of people watching, learning, observing. And I think every month, every day that goes by, more people lean into DeFi. And so I think the market adoption and the growth is inevitable, and it's happening. I am curious to see what institutions do with DeFi. I think the stepstone of buying some Bitcoin, buying some ETH, and then starting to build a broader portfolio. A lot of institutions are like, okay, now what? And then how do I put my crypto to work? And I think DeFi is obviously that solution, and there's very little of that capital in DeFi today. So that alone will really shape a lot of the growth over the next several years in DeFi. I am obviously, on the regulatory standpoint, want to see some responsible dynamics on that front, but also don't want innovation and jobs and capital and everything else to go outside the U.S. That would be, I think, a huge mistake. And so I think both this industry and regulators need to be a lot more thoughtful about the approach on that. And I think there's obviously a lot of interaction now that has never been there in DC and elsewhere in Brussels to really engage and make sure that this innovation doesn't get cut off at the knees, if you will, and then starts to go offshore. And I don't think that's a good outcome, but I think some better clarity is important, because I think that's what a lot of the institutional investors want. It's like, while they want yield, they're desperate for yield. They can't find it in traditional markets in an effective way, and they're obviously seeing this in DeFi, but their hesitation is real because they're regulated, they're public, etc. And so I think some of that work on the regulatory front will be really important in shaping DeFi for the next several years. Absent that, super inspired by the innovation that's happening standalone, and I think we're in the right spot at the right time in terms of DeFi.
Linking up to that, Brian, what are your thoughts on is DeFi going to take over traditional finance at some point? Is it going to be a tipping point where we stop using the bank and start using MetaMask at scale? What are your thoughts on that kind of transition that's slowly happening, but will it ever be complete?
Yeah, just sort of piggybacking off what Matt and Michael were addressing in some of the comments. And so in short, DeFi is already eating CeFi, but we have a long way to go. I think right now, we just crossed the 3 trillion in market cap for digital assets, with DeFi around 120 or so billion. That's very small in comparison to traditional capital markets, which are, if you look at like the fixed income and public equities markets, they're, north of 40 trillion, right? All that capital is sitting off chain. It has not made its way on chain. It is, being dealt with in a sort of Web 2 fashion, right? So the curve of adoption is long. And I think, there's lots of exciting innovation and opportunity and sort of these, new narratives that are coming to light with DeFi 2.0 and continuing to push the frontier of innovation forward with cross-chain collaborations and, different liquidity pools, et cetera. But, there is a tremendous opportunity to address this wall of institutional money that's just sort of waiting on the sidelines to come in, and I think the blockers or unlock for that are, sort of at the execution layer for a lot of the risks that need to be addressed. Compliance is definitely one of them. Regulation is inevitable, I think, in this space. We haven't gotten clarity, at least here in the US. Other jurisdictions have been able to provide a little more clarity, but I think until that's solved, that capital will continue to sit on the sidelines, and we're getting closer by the day, I think. But taking steps in the industry and addressing that directly, that's something we've been really focused on, is sort of solving that trusted counterparty problem. Liquidity risks as well, just sort of concentrating, it's a very fragmented experience with multiple opportunities for alpha in the space, right? So having that, breadth and depth of institutional assets and on chain for the institutions to come in is what's needed. And then also reducing that education gap and the connectivity and control. I think that'll really solve a lot of those problems for these institutions as they sort of wait, for their opportunity to come in.
Absolutely. Talking about waiting for an opportunity to come in. I mean, we might have Lex close the session today with, if you had $3 million sitting just chilling in your MetaMask account today, where would you allocate it to? Just thinking about 2022 and the opportunities on the table.
Ooh, I'm an asset allocation person, so I would spend some time on putting things into yield, and then I would spend time thinking about market making and providing capital into pools, and then probably projects at the edge like Tokamak and some of the things around mechanics on Olympus DAO, as well as things that are more performant computational blockchains that connect into Ethereum and expand Ethereum's capabilities. I think those are key. I would also point to the creator economy and the fact that most of the people over the last year that have come into the space have actually been like 18-year-old billionaires, right? To make an obvious joke, it's creators who are making beautiful things, generating commerce around it, and connecting into communities governed by DAOs. Rather than merely financial features. And so I think a lot of the growth coming up and a lot of investment is going into that, into blockchain-based gaming, into digital objects that are interactive and that generate communities and tribes and philosophies. And so, outside of just the machines that we here make in order to generate numbers on a screen, there's also sort of human connectivity and games that we can play together.
Thanks so much. We are right on the dot here. I really appreciate everyone's time today. We shared some good nuggets. I know there's going to be a video recording of this later on. If anybody wants to get in touch with the speakers, I'm sure LinkedIn is a known source of stalking. Otherwise, thanks so much for your time, and hope to see you around soon.
Thank you.
Thank you.
Thanks, everybody.